Your money is not safe in the banks because this is the financial crisis part 2. You came here for the truth, so let me unveil that for you. In today's video, we are going to look at why this is not exactly the financial crisis part 2, but I'm going to show you where the weakest link is. Some have said this is it, all the banks are collapsing, it's going to take everything with it, there's going to be this major deflation that's going to empty out the bank accounts, and of course the FDIC has no ability to save everyone, so there's going to be chaos. Well, let's look at fact versus fiction. I have been breaking this down every single day for many years. Now, if you haven't been staying tuned to this channel that whole time, don't worry, I'm going to explain it all. I have it written down, the points that I need to get to, so you'll be up to speed in this one video. Let's get into it right away. We'll take a trip down memory lane. As you can see, New York Community Bank agrees to buy a large portion of Signature Bank. This was back in March 20 of 2023. And so you have NYCB. They're saying, hey, we're going to step in. Signature Bank starts failing. No worries. We got it. All right. And then what happened after that? You had some other banks that began to fail, SVB and others, Credit Suisse in Europe. So we had a big problem. And they had some things that I'll show you here. And they stepped in with the Federal Reserve, starting the BTFP, Bank Term Funding Program, which is a lifeline to the banks who need it. And more recently, there's been some changes with that lifeline. And so they kind of stepped in and basically said, all right, so the story is you need some money, you need some of this cash at the time, liquidity, but who's going to accept it? And so what we found out was the initial response was, okay, it wasn't that big, but it started to grow and grow and grow. But they realized as time went on that this was a way to simply use the BTFP as a source of income. They were making money off of this. But who actually needed it? It was the small banks. The small banks were the ones who were having these issues. So those who needed the money most, yeah, they were taking it, but there's a fundamental problem here. And I'm going to explain that in a moment. Let me show you this. This is now. Signs of trouble at regional banks reignite sector fears. New York Community Bank Corp credit rating cut to junk. Shares fall 26% on Friday. Okay. There is a definite problem at this company, and you know that. Why? Because when you see the quotes, the president, the CEO, everything is fine. We are going to be just fine. Take your money and run. Go on, take the money and run. Okay? That's exactly what you've got to be doing if you got your cash anywhere near there. Bank stocks slid on Friday, led by 26% decline in NYCB after more signs of trouble at the lender, and a small peer revived fears about the stability, of the sector a year after a string of high-profile failures. Everybody thought it was done. It was swept under the rug. And for the most part, it was. We don't know exactly what went on. A lot of that was kept away from the public. But we do know that no more public failures, one or two here and there, but it wasn't a big thing suddenly. So, hey, the Federal Reserve resolved the crisis. Stocks didn't really come down that far as a result of it. Banks didn't start laying off people like crazy. It was certainly contained on the surface. Now this is the biggest crack we have seen since March of 2023. Exactly a year later. Kind of odd the way that's been working. So NYCB closed to its lowest level since 1997. So they've got problems. They're not the only one. Material weakness, as they see here. That language is particularly troubling. That creates a lot of risk and uncertainty. So what happens? It is a snowball effect. The company's done at this point. You can't resolve this. This crisis is going to result in another company buying them up. All right. And who's that going to be? It's going to be the JP Morgans of the world, whether it's JP or another. I'm sure there will be some big bank that steps in and saves the day. They buy those assets for pennies on the dollar. Congratulations. Fitch Ratings cut their credit rating to junk after the bank's recent disclosures prompted a reconsideration about how adequately it is prepared for potential commercial real estate losses. That's when I need to get into the details of what's been going on. Very short 2-minute history lesson. What's going on here? Well, March 2023, banks failed, and then NYCB stepped in. Okay, so there it is, extending the lifeline. They're like, hey, we're going to help you out. Regional banks are one of these issues because they loan to the commercial banks. They are the ones that do this overwhelmingly. So they can then take their capital that they have, they give it in this loan over here. Hey, we're going to loan this out to you. We're going to give you cash. But there's just one problem. You see, interest rates were very different a few years ago than they are today or in 2023. And that's where things start to get messy. All right. Quickly, what happened? Why? These banks, they basically lost a lot of money. And why did this happen? When they were buying assets, remember, if you got a bank and you're going to put your money in that bank, you're going to put it into some sort of, guaranteed return, whatever the case is, they take your money, okay, whether it's through a deposit, whether anything, they have to give you a rate of return in advance. So they're going to invest in something. They were investing in things like mortgage-backed securities, even though it's garbage. Why? Because when everything was at 0% interest rate, these mortgage-backed securities were giving a little bit. But time passed. Interest rates rose and everything was giving cash. Those assets they bought, though, years ago were now worth much less than they bought them for. And this created a big issue because now they had all these losses. At the same time, they're heavily exposed to commercial loans, commercial real estate. And those have been dealing with a lot of problems. And you might be thinking, small banks, small problems. It's not the case because most of the loans are actually from those smaller, don't think small, like super small banks. It's really just regional banks. SVB was technically not part of that in a sense, right? They're a big bank in a sense. Think about that in that way. Okay, their exposure is the issue. Rating agencies started to downgrade them. When they get downgraded, now funds have to turn them away. Oh, we don't want that stuff. It's not the grade that we want. The higher up in grade, the more attractive it is to investors. So ratings in that sense do matter. Same similarities to the financial crisis. There's no question about it. We do have this, but it's on the commercial side. The commercial side is where we have the problem. You have one thing, the rating agencies start to finally get wind of it and start to downgrade. You have problems because one thing is buying up another, then that's failing. This is a collapse that's going on. And how do you save it? How do you save a banking system from collapse? Think about that. We'll get into it in a moment. This is the regional bank ETF, which, basically wasn't even scared, one down 1%. So you've got a very serious problem, and yet it's down by 1%. So they're not afraid. Investors are not afraid right now. There's so much love in the markets. Office tower deal for $1 reveals anxiety among long-term buyers. Largest Canadian pension takes steps to limit office exposure. They don't want it. Here you go. Gone. $1. This is Canada. It's the exact same issue. Nobody wants office. Nobody wants retail. It's not what's desirable right now. I mean, there are pockets, of course, or whatever, but the point is, in general, that's an issue because there is debt associated with this. Imagine you build a big tower that's built with debt. The debt is never, ever paid. You got to understand this. People don't get this. You build a big tower. That tower is built in 57, okay? You look at it today, that building still has debt on it. They're constantly refinancing. That's the way this works. These big properties, they have this ability to do things. And in the US, there's a lot of ability, even other places too, with refinancing. But I mean, they're taking advantage of the circumstance. So that debt, you got to know what you're doing. You got to take the money out at the right time. You got to be able to anticipate this. But when interest rates rise, which have not been happening for a very long time, think about this. So imagine they've been going down this whole time. They start rising. Now we got a problem. And that's what's going on right now in commercial real estate because it's short term. The problems are much worse in Canada for some things than in the United States. You could see disposable income on both sides versus the housing prices. What do you see? What do you see? If you can't even read that, you can, like the text on there, look, the US is on the left, Canada's on the right. The disposable income is nowhere near where housing prices are. The most extreme example of a housing bubble is in Canada right now at this time. Be warned about the dangers that could occur. And this is all hinging on the Federal Reserve, the Bank of Canada, and all the rest really doing a significant change to their whole policy, and that is starting to cut interest rates. But as you see here, PCE, that's the personal consumption expenditure, which is the Federal Reserve's favorite measure of inflation. Well, it shows the biggest rise in the US inflation in 4 months. So you got an issue there, right? If they are saying this, if they're like, yeah, well, inflation's going up and we're looking at our metrics, well, we cannot cut interest rates yet. We are not there. And so this is the issue. However, you get into a bank crisis, inflation's still coming up, they can start to do a backdoor QE, backdoor quantitative easing in order to prop up these banks, in order to make sure that liquidity stays flowing. They will devalue your currency significantly. Understand that they will allow inflation to go wild if it means rescuing the banks. So this is the dilemma that we have today, that the banks are undergoing stress, commercial real estate, regional banks, those are the big issues. And then you move out and look at where inflation is going. This is the issue because they got to start cutting rapidly, but inflation's still too high according to some metrics. We will see what happens. And if you want to know all of this in depth, everybody on my Finance Friday, there's more people joining all the time, and I'm so appreciative of all these people listening to me for 2 hours, getting into the depths of this stuff. You can't do that in a 10-minute video on YouTube. This is 2 hours every single Friday. Finance Friday Live. Shout out to the Finance Friday Live crew. I want to thank you all for watching this today. Check that link in the description if you want to know more about that. Hit that thumbs up button on the way out. I do appreciate that. Can we get the fireworks to happen? All right. I want to thank you for being here, and I'll see you tomorrow. Take care.